pleasure of welcoming everyone to this post-monetary policy committee briefing by the governor of the central bank. I am Bosin Amofaye, and this is coming to you from Frontier Africa Reports. Let me welcome my panelists this afternoon. The governor has just announced the decisions of the members of the Monetary Policy Committee, the third meeting in the year 2020. Let me just introduce my panelists who will be chatting to the latest considerations and the decisions of the MPC members. Mosope Arubayi is a macroeconomic specialist at Vertiva Capital. She's joining us from Lagos here. And also on the panel is Wale Olusi. Thank you very much for coming through. Wale Olusi is the head of research at United Capital. And also joining us from Lagos is Uchenna Minis, who is the CEO at Blue FX Nigeria. And of course, the final panelist here is Ali Khan Sacho. Ali is the managing director, CEO and founder of Reach Frontiers based in Nairobi, Kenya. Thank you very much, ladies and gentlemen, for coming this afternoon, about almost 3 o'clock Nigerian time. Let me start with you. Ali, you're the only one out of these members or panelists who are sitting outside Nigeria. So let me just go straight to you and start with you. What's your take on this decision by the Nigerian Central Bank, the consideration of the members to cut interest rate by 100 basis points at this time?
Well, I think, thank you, Boason, for the introduction. I think I would have thought that not many people really expected that rate cut. I think it was a bold and decisive move. Bear in mind that actually conditions are quite tight, as I understand them, in the Nigerian market because of the CRR rate being quite elevated. So yes, I think it was the right decision. What struck me as well, Boason, was the prediction around GDP. The IMF, the World Bank, all predicting a recession. And the MPC here struck me as quite bullish, saying that they think they can escape a recession and look to be growing again in Q4. So my takeaway was actually they were more constructive than I think international markets in particular had been reading the situation. And I thought 100 basis points was the right move, given Nigeria's dependence on some hot money in the local currency markets.
Oh, thank you, Ali, for your first word. Let's take the first word from Mosope Arubayi from Vertiva Capital. Mosope, this is all against expectations that the Nigerian Central Bank will cut interest rate because of the peculiar macroeconomic environment. And here we are, the MPC surprised by 100 basis points cut to the downside. What's your take?
Okay, just as you said, it comes as a surprise, considering the fact that in my opinion, I feel this actually undermines the external sector risks that could crystallize. However, I want to believe they've also put this into consideration. A number of inflows from the World Bank and the AFDB is expected in the course of the year. So maybe they just feel they would be at a better position to manage some of the external risk or scale through some of the external pressure that could rise this year. But yeah, it comes as a surprise. And the governor even said it, that they need to be sensitive. They need to give a signal that they are supporting growth at this time, since that's what is being done globally. So yes, it's a bold move, but we're yet to see how that would. We're yet to see how they would manage the external risk that could crystallize as a result of this cut.
Thank you for your first word, Mosope. Let's take your views. Wale Olusi, in terms of this, do you think the central bank has now joined other central banks around Africa, Egypt, South Africa, Rwanda, and Ghana, including Kenya, where Ali is, to cut interest rate? Some of these central banks have done at least twice rate cuts this year. Do you think this is now, this rate cut, 100 basis points, is enough to support the kind of growth that the MPC is seeing in the broader economy?
Thank you very much for having me, Boason, and joining the conversation. Yes, I think the 100 basis point reduction in NPR comes as a surprise. When GDP number came out earlier this week, and it was weaker at about 1.87%, which is the slowest in more than 2 years. We suspected that maybe the MPC will want to look at, an indicative rate cut, but we thought they would be constrained by the external sector concern, because there's still a lot of pressure on the exchange rate as we speak. And you would want to think maybe they will be concerned about, finding a way to, maintain or reverse net capital outflow. But now that they've done this, I think your question is spot on. Is this enough to spur the kind of growth that we are looking at? Well, one, I think it's kind of an indicative reduction, because if you look at the effective rates in the market, we do a lot of debt issuances for our clients, and we know that if you look at the NTB space, which is where we price our commercial papers, rate there is low single digits, except for yesterday when we saw a rate at around 4% for 364-day. Effective rates in the short-term market is 4% or below. In the bond market is around 11%. So effective rate is actually still, reasonably lower than what the MPR will be now at 12.5%. So, whether that will, spur the kind of growth we have, I think I doubt it. I think the rate in the system already suggests that, people can take advantage, and we've seen a lot of bond issuances this year, implying that, the private sector is taking all the advantage of the liquidity in the system to raise capital. But is it enough? It looks like the private sector is a bit too shallow compared to the size of the liquidity that we have. So, you might not see the kind of growth you want as a result of, this rate cut. But I think because it is indicative, it supports the expansionary monetary policy of the central bank, is also in line with what other central banks around the world are doing. I think is also a bold step, and is the right thing to do.
Okay, thank you, Wale. Uche Namini is the CEO at UFX Nigeria. Where is the as part of the external considerations here will be the exchange rate for Nigeria. So Uche, what's your take on this 100 basis points? How do you think our traders will take this to the FX market if you look at our exchange rate? Well, how do you think this will be played forward?
One of the things that we should really pay attention to is the central bank in itself is in a precarious position, in that they need to consider the external factor risk, and also they need to consider the internal risk, as it were. We can also hear from the governor highlighting that the manufacturing numbers are deepening compared to last year, and that in itself is trying to say where exactly they can mediate that risk in terms of external and internal. And that's what I think they have done, although it's surprising, but I think it's necessary, because we are in an unprecedented time in terms of external risk, in terms of the pandemic and other risks that we can't really quantify at the moment. So it's best that they are, should I say, aggressively reactive than they do nothing, because that in itself can come back and hit us hard. So yes, there is going to be that continual downside pressure in terms of the external risk, but we need to also look at the negative feedback loop in terms of the manufacturing sector, the real sector, having access to cheaper credit to continue to support growth. I think it is, yes, we can say it's surprising, but I think it's like a smart thing to do at this time and at this point.
Smart thing to do. Let me quickly ask Ali in Nairobi. Very quickly, Ali, what do you think should be the key focus for Africa's central bankers within this COVID-19, at least in short to medium term, trying to pacify and keep foreign portfolio investors happy, or try to support domestic growth in terms of monetary policy? Where do you think the key focus should be as we see this aggressive interest rate cut across the sub-Saharan Africa, including Egypt, even in North Africa?
So I think that's a really interesting question, and I think different countries have different sensitivity to foreign investors. I think particularly in Nigeria, the issue is this enormous holding within the local market, where you've got people getting paid very handsomely, a lot of them looking to exit, and therefore you've got to be cognizant of that. But essentially, it seems to me that central banks across the continent have decided to cut rates quite dramatically. Nigeria was lagging. You've seen it in South Africa. You've seen it in Kenya, where we're at 7%, even Zambia. So it seems to me the central banks have made the decision that they're not going to hold local interest rates hostage to foreign investors, particularly in a situation where you're dealing with a macro gale force wind, where foreign investors have been exiting emerging and frontier market risk. And that's why you've seen this tremendous volume of money. I think, the highest amount of money has left emerging and frontier markets in history, much more than 2008. So I think the central banks have made the correct decision about that. And really, I think we're still dealing with some difficult to deal with situations. And, we're dealing with a very, notwithstanding the rebound in the commodity markets, I'm not convinced that the oil price is going to hold here. I think we could have another lurch lower that would add pressure. I'm seeing weakness in copper prices, for example. So my overall view is I think the central banks, are kind of working in a very fluid environment. You've got this circuit breaker of COVID, which I think, I know we've been patting ourselves on the back in many cases saying how well we're doing. I think that's all nonsense. I think we're just at the cusp of a breakout on COVID. And the question is, how are we going to respond to what remains a health emergency, which is now finally beginning to emerge? So overall, I think we can't do very much. Foreign investors will come back, but for now, we've got to concentrate on stimulating our own economies with our own resources. And that, to me, Boasson, is key at the moment. But the problem is, with very weak GDP growth, what exactly are you stimulating by making more credit available? The consumer can't spend, the banks are not lending to the consumer, and where exactly are you going to put that cheaper money to work?
So that's the question I'm asking Mosope here. The governor, Godwin Emefiele, reeled out dozens of billions of naira spent already, thrown into various sectors to stimulate and try to mitigate the impact of COVID-19. I think yesterday, the Apex Bank also issued a statement asking other financial institutions to rearrange loans that have been given to households and businesses in relative to COVID-19 stimulus, and reduce the rate on some of his own interventions from 9% to 5%. So this, what you call helicopter money, do you think this is good enough to support what the fiscal authorities is doing, for the governor to sound very confident? Twice in this MPC communique, he said if efforts are concerted, Nigeria can escape recession in 2020. Do you think he's sounding just as a salesman, or he's been very realistic based on what the members of the MPC actually said at today's meeting?
Okay, thanks, Boasson. Just to add to what Ali just said, in my opinion, I feel countries that are a lot more reliant on oil receipts for a significant portion of their FX earnings have like limited monetary policy space. So even though you see South Africa doing over 200 bips cut, or an Egypt doing over 300 bips cut in year to date, I wouldn't expect Nigeria to go that far, because we're still reliant on oil earnings, and investors are actually sensitive to the fact that 90% or more of our FX comes from oil receipts. And the same thing applies to Angola. Angola has also not touched their interest rate since last year. So we're on the same table. So just to pinpoint that. And with the respect to growth, I think it's actually a realistic point of view, considering the fact that we escaped the recession trend in Q1. compared to a number of countries, GDP numbers that I've seen for Q1, we did exceptionally well. And of course, it's for the fact that we did not come under the pandemic significantly in Q1. The lockdown didn't happen until towards the end of March. That's 31st of March. So yes, we might feel the impact of the lockdown Q2, Q3, because we didn't have a lot of health facilities in place to manage the pandemic. So we're still trying to cope with and manage the situation right now. So yes, it would most likely extend to Q3. But Q4, just as the governor said, we also expect that the economy would bounce back. Maybe not as strongly as maybe we're not as optimistic as the CBN, but I think a Q4 mild growth and a Q1 strong growth is enough to pull us out of a recession. Q4 contribution to annual GDP is the highest amongst the quarters. So if we're able to do fairly well in Q4, and we've done quite well for Q1, we should be able to escape a recession slightly, maybe not strong growth, but we can miss a recession. That's my take.
Okay, so let's go straight to the marketplace. Wale Olusi from United Capital, you work for an investment bank as the head of research. What do you think the market reaction should be to this latest decision? Very surprising, out of the blues, 12.5% policy headline rate cuts to that new level, but while leaving our cash reserve ratio and liquidity ratio unchanged.
I mean,
let's start on the fixed asset, fixed income side, treasury bills and bonds.
Okay, so for the fixed income market, I think that this is just a signal from the central bank to market participants that they shouldn't be expecting any increase in yield or a high rate environment. Many of them, if you look at the range of bid that we've been seeing, you will see a range of bid for NTB, for example, between 3% at times to as high as 14% when they try to price in what is happening to the OMO market. And in the bond market, we continue to see a lot of bid, that is way much more than the offer. Last week, over 300 billion was allotted, but the initial plan was about 60 billion. But I think this simply tells that you probably won't be getting a situation where there will be a spike in the yield environment as a result of the fact that inflation is trending northward and there are concerns around recession. But it looks like the CBN is confident. It has probably checked, or it has done all the permutation and combination, and it's clear that they have enough weaponry in their artillery, in their arsenal, to be able to manage what is to come. So I think for market participants, it simply sends that signal that yield might not be spiking the way they would think, because of there's a lot of demand coming from governments, because fiscal deficit is actually quite huge going forward. For the stock market, I mean, this also tells that there's a lot of confidence coming from the policymakers, that recession might not be as bad as people are saying it. But I don't think we will miss a recession. I think if you take out 2 months out of 10 and you lock down the key economies of Lagos State, Ogun State, and the FCT, if you put the three of them together, they account for more than 30% of the economy. I think we are going to take that hit, definitely in Q2 and most likely in Q3. And if you have a 3 straight quarter of either a contraction or a slowdown, that's technically a recession. So I mean, that would be a concern for investors. But the central bank is sending a lot of confidence signal into the system. We can only wait till how they react tomorrow to see actually what they will do. But as of today, the stock market already closed negative. Yesterday, it was on fire. It was, up across all segments. But the bond market was relatively quiet.
Okay, a quick one on to Ali in Nairobi. Ali, we've seen a bit more. Let's go a bit more external in terms of the geopolitics, the ratcheted up of the saber rattling between mostly from Washington and fired across to China and all of that. How much of all these global headwinds, if you want to put it that way, could have negative impact on the outlook for resource-based hydrocarbon economies such as Nigeria moving forward? You said earlier that some said, look, we could see oil prices taking another tank before the end of the year.
So that's a great question, and I think if I can just frame it a little bit, if you look at African commodity-based economies, the China-Africa feedback loop phenomenon has been positive for approximately 2 decades. Growing Chinese demand, if you look at some of the data points, 20 years ago, China consumed 3 or 4% of the global copper production. Today, it's over 50%. So that feedback loop phenomenon, largely positive, turned negative, I would say, about actually preceded COVID. It was beginning to turn negative, slowing down the US trade war, and all that chatter we had last year. And then we thought the phase 1 deal was going to fix it.
To take you to continue on that trajectory as far as the US-China face-off, coming at this point when the world is still grappling with COVID-19, then we have geopolitics coming into it. Again, how much damage do you think this will do to market confidence, in particular the exchange rate, the currencies market, as you can see it as a trader?
So it's very clear to reiterate what Ali was saying, that he's still looking at the possible leg lower in the commodity space. What I need to emphasize too is to say that whatever central bank governors, administrators are put in place, everything literally is based on hope. It's based on the possibility that we don't have a second wave of corona pandemic. It's based on the possibility that we don't have any other external risk continue to mitigate in terms of the geopolitical risk we've just mentioned, with China and US continue to escalate. We have an Hong Kong issue right now trying to build. We also have different risk building from different sides. There is the China and India border war that can look to brew up and sort of kind of precipitate into the global market space. So you look at all of this risk, and there is the possibility that we can see fresh downside pressure into developed markets, frontier markets, and emerging markets. So yes, it is a significant issue. We'll see that spread into a market like ours, because we are really very, very exposed in terms of our revenue when we get from oil sales. Another thing we also need to pay attention to is because the central bank governor, they are looking at the possibility that oil prices might continue to probably trade sideways and may not get to that benchmark that have been priced into the budget. And that in itself is why they are looking at trying to stimulate other sectors. We can see a major part of a GDP contributor is to the non-oil sector. I think they're just trying to play what they have at hand and hope for the best, basically. So the scene of the concept of saying, oh, we would not get into a recession is based on hope. It's a hope strategy, really. It's not really on anything based on actual fundamentals. It's based on the fact that we don't get to see risk precipitate going forward.
Well, perhaps if we do our homework very well, if we continue what we're doing, perhaps we'll escape recession. But very quickly, I'm also going to ask Mosope and Wale. Mosope, to you first. The MPC, the statement, praised the resilience of the banking sector. That's what the governor read out in that statement. The resilience of the banking sector, at least in Q1 so far, with the pandemic and all of that. You folks work very closely with the banking sector, so I'm sure you have an idea. Is this a statement of fact that yes, the banks have shown very resilient? We haven't seen the first quarter. We've seen the first quarter numbers for the banks, but again, the pandemic happened at a point in which you think Q2 numbers from the banks will reveal a lot more than we currently know at the moment. Mosope, let's start with you.
Okay, so from what I gathered from the statement, non-performing loans are actually within like range. Five are actually low at the moment. So I want to believe it's because companies that actually took facilities from the bank are actually paying up. However, Q2 we had lockdowns, many lockdown across like major cities in the country, and many businesses did not operate, let alone earn enough to pay employees or service their current obligations. So we could see that number deteriorates in Q2 and possibly Q3 if the lockdown, if the full reopening, which they intend to do, is not completed in Q3. I believe it should be completed in Q3 because I've seen a timetable of the phased reopening of the economy. So if we're able to implement that, yes, I feel by Q3 NPL numbers should reduce further as more companies go back to business and begin to generate more income. However, just like Uchenna has said, where it's not about non-performing loan numbers not being impressive. It's about the pandemic, and it's our crisis management ability that counts at this point. If we're hopeful that things will be back up and running in Q4, we have to manage the crisis properly. Also, the return of foreign investors is also dependent on our ability to manage this crisis, because nobody wants to put their money into uncertainty. There have been talks about the second wave. If we're not able to manage this first wave properly, we'll probably not scale through the second wave, and we might not see those foreign investors come back. So in as much as there's a hope strategy, I'm also seeing the testing numbers go up. I'm expecting that at least before Q4 would have increased our testing capacity, would have learned as much as possible to ensure that everything is up and running in Q4. But if that fails to happen, most likely NPL numbers will deteriorate, and everything that we expect to happen might just go southwards.
We hope we get all our hands together on all the new safety measures around social physical distancing and all of that. Quickly, Wale, what's your take? The banking sector is very critical to everything we're doing, whether we're funding the pandemic, trying to soft land households and businesses in terms of exposure of banks and the central bank itself via its own interventions by cutting rates from 9 to 5%. Do you think this is good enough? This will keep the bank very resilient moving forward?
Well, I think the bank they've always found a way to, sail through whatever, you throw at them. I think their capital position, they are, in good shape at the moment. We saw a spike in impairment provisioning in Q1, and that's expected because based on the IFRS 9 that, is currently in operation, when you have an outlook that is a bit more uncertain, then you should make more provisionings. And that's what is happening. And, it will also affect your NPL numbers as well. But, we think they can, especially the tier one banks. We think they have, the thing about Nigerian bank is that they have a stricter measure in terms of their prudential guidelines, and this is something that has been put in place since the time of, Governor Sanusi and, Governor Emefiele also consolidated on that. Our capital adequacy ratio, for example, is one of the highest around here. So we already have these guidelines in place. Hence, the continuous narrative around how resilient Nigerian banks are. I don't think the loans, will get back to the levels we saw in 2016 due to the oil crisis. I think, they've learned from that. We are barely even out of where we were then. Take a First Bank, for example. They've completely cleared out all those bad loans then. They're actually coming out. And many of them are a bit more careful, despite pressure from central bank to expand their risk portfolio. They are a bit more careful at creating, credits that will, worsen their asset quality going forward. So I think somehow they will find a way. Their margins will be affected. Many of them are reporting slower or slight decline in revenue numbers, but their loan growth is, okay as at Q1. We think it will be slower going forward because of the, risk in the horizon. I think at the end of the day, their margins, their PAT is where, some of these things will affect. But by the time you take the fact that they report in Naira and you've adjusted the currency, their foreign exchange gain will also want to make up for that. So for me, I think the Nigerian banks, they will always find a way. They will find a way to stay resilient.
Yeah, very interesting. If they sanitize their loan books from the 2015-2016 period, they don't want to get new virus onto their
correct.
loan book.
And if I may add, remember that late last year, what we also saw was that many of them with Eurobond, they started redeeming it early. Almost half of all the banks with Eurobond outstanding in Nigeria all took out these liabilities. So many of them are having dollar assets now rather than dollar liabilities. So, I mean, they're in a better position than they were then.
Yeah, very, very interesting. As we begin to wrap up, let's wrap up from Lagos. Then we have the final take from Ali, who's back in Nairobi. So let me start with you, Moshope. How do you think the markets will take this tomorrow? It's a Friday. So what's your bull and bear case for the markets tomorrow on either on the equity side or fixed income side?
Okay. For the equities market, I think we could still see sell-off in the market. I expect the market to close negative. However, in the fixed income space, we might see some bullish sentiments in the fixed income markets based on the MPC decision of today.
Okay.
Thank you.
Thank you so much, Musape from Petipa Capital. Wale, back to you very quickly. What is your bull and bear? What's the playbook for tomorrow, the final trading day of the week?
Well, for equities, I think it has rallied for more than 5 to 6 days. Like I mentioned earlier, it was really up yesterday. So I think profit taking will probably continue. But the story for equities, it looks quite volatile. By the time Q2 numbers start coming out and people start seeing the realities of, what this COVID-19, of course, you will see some, negative reaction. But once you get to certain prices, what I've seen is, people start buying again. There's a lot of liquidity in the market. I agree with Moshope for the fixed income market. There's nowhere to put all those money. So it's still a bullish case for the fixed income market. People are just trying to take whatever it is that they can get for now.
Okay, you folks continue to have these guys on the fixed income continue to have a good time. So what will it look like on the FX side, Uchenna?
Yeah, I still believe that we can get initial fear of missing out, should I say, reaction from investors. But as we continue as numbers continue to unwind and come out, we'll start to see reactions and investment sentiment sort of kind of correct to their fair value. We expect that downside pressure in terms of FX, in terms of Naira compared to the US dollar. We still have that significant US rest of the world growth differential that will continue to push the US dollar upwards, despite what the Federal Reserve has done in terms of their printing machine. But the rest of the world are still underneath in terms of growth, and we continue to see that pressure, which would translate and transfer into that risk into emerging market and frontier market. So for us, I still see the Naira still weakening going forward. I think that can change when we have like a clearer outlook on what oil prices will be looking to do on the commodity space generally, and basically that's basically what it is.
Thank you very much, Uchenna. Finally, Ali, yesterday the Central Bank of Kenya did a monetary policy meeting, decided to leave policy rates unchanged. So how does it all has it been playing out at the marketplace, at the Nairobi Securities Exchange, and at the debt market in East Africa's largest economy?
So they've already done quite a bit of easing here in Nairobi. We're now at 7%. But the issue really is transmission, lending on to consumers and lending on to businesses. And so far, we're not seeing much of that happen. We're seeing more restructuring around bank portfolios. Equity Bank yesterday increased their non-performing loan provisioning by 700% as they reported Q1. So overall, stock market has been very weak. If you strip out Safaricom, we're at a 20-year low. Banking stocks have been hit quite badly. Equity and a couple of other banks skipped paying a dividend they'd already promised to pay. At the last moment, they said they weren't going to pay it. So there's been a very bearish sentiment in the equity market, and I think that will continue for a bit longer until we see an improvement in the economy.
Okay, thank you very much, Ali Khan Sacho, the CEO and founder of Rich Frontiers from Nairobi, Wale Olusi, the head of research at United Capital, an investment bank here in Nigeria. Mushope Arubayi, thank you so much, head of macroeconomics at Vetiver Capital Management Limited, and of course, Uche Namini is the managing director at BlueFX Nigeria. Thank you very much for bringing your thoughts to bear on today's Monetary Policy Committee decisions of the Central Bank of Nigeria. Thank you very much for your time. We appreciate your comments and your contributions here at Frontier Africa Reports. Thank you so much, and see you next time, everyone.